Your monthly payment is a direct correlation of what your credit score is. It's also impacted how much you're putting down on the down payment, if you're putting more or less, but the credit score will impact the PMI. The credit score will impact your interest rate.
Today we are very excited to chat with Eva Kokoshishka with Harbor One Mortgage. By the way, I'm Juliana with Century21 XSell Realty. Eva has been doing loans for over 23 years. Last year, she was the affiliate lender for the Central Mass Board of Realtors. So we're excited to talk to Eva today. Our topic for today is how does your credit score affect your loan? Hello, Eva. How are you this morning?
Hello, good morning. Thank you for having me. It's a pleasure, and I'm very flattered that you've asked me to be part of this.
Oh, we are very excited that you agreed to do this. We've known each other for a long time. We've been helping families live the American dream, and today you will tell us from your vast experience all that people to know about how their credit score affects their loan. I will start with how is your family and yourself? Everything going well?
Yes, thank you very much. We are very blessed. Everybody is healthy. Kids are doing well, studying, doing their work. I'm trying to do the best I can in this COVID environment, but no complaints. We're all doing very well. Thank you, and hope
Nice.
as well.
So let's start with the buying power, how credit score affects one's buying power.
So multiple impacts. First and foremost, you're going to have limitations as to what kind of programs you're going to be able to get. So if you want some specialized programs, let's say you are a first-time buyer and you would like some down payment assistance, you're going to need to have at minimum a 680 credit score. Okay, if you're buying a 2 to 4 unit, you're going to need a minimum of 700 credit score.
Okay.
However, it's very deceptive to just say the credit score, because you could have a 740 credit score and you could still get denied because it's overall history, a pattern of how you pay things. So sometimes people think, oh, I have the minimum score. Well, maybe you do, but maybe there's other things in your past payment pattern or payment history that will not allow you to get an approval.
Okay.
Everything nowadays, as you know, is automated. Very few manual underwriting of files. Like back in the day, we used to take a calculator and calculate everything manually. Now, they're automated. So whether it's a conventional loan, whether it's a government loan, VA, FHA, USDA, everything is automated. So your credit profile is automatically uploaded into the underwriting system.
Okay.
And unfortunately, that system is going to read how you present yourself based on your credit score.
Okay.
And that decision is going to be made based on your credit score, your credit profile. The higher your score, the more options you have. The lower your score, it's going to limit which programs you qualify for.
Oh, that's good to know. And how does that affect your mortgage insurance when you are also?
So it impacts so many different things. So it impacts your mortgage insurance in the sense that if you have a conventional loan, we have what's called PMI, or private mortgage insurance. And that private mortgage insurance is priced specifically based on your credit score. The higher the score, you present as a lower risk.
Okay.
The lower the score, you present as a higher risk.
Okay.
So your monthly payment is a direct correlation of what your credit score is. It's also impacted how much you're putting down on the down payment, if you're putting more or less, but the credit score will impact the PMI. The credit score will impact your interest rate. Okay, so on a conventional loan, if you're below a 740 credit score, you're going to get a hit to the rate because you pose a higher risk. And it goes in 20-point increments. So are you below 740? Are you below 720, 700, and so forth? So just to give you an idea of what does that mean? Well, let's say that based on your credit score, you have a good credit score and you qualify at a 3% interest rate today, okay? So at that 3%, let's just use an average $250,000 home. So your monthly principal and interest, I did the math, I cheated ahead of time, don't think I'm so smart to remember this. But on 250,000, 3% interest rate, the principal and interest payment would be $1,051, okay? So let's say your credit isn't so great, you get a hit to the rate and it's a 3.25 because your credit score is a little lower. That same loan amount, the monthly payment would be $1,085. That means $33, actually $33.70 more per month. So on a course of a year, you're paying $404 more because your credit is a little lower. If you have that loan for 5 years, you're talking $5,000. Maybe not so much of a difference for you. Maybe you're okay at, affording it. But as far as the approval process, it may make a difference. Because from the approval perspective, what we are looking at is your debt to income. And believe it or not, that $33 a month might mean the difference of you being able to be approved versus you being denied because you exceed that debt to income tolerance. The system no longer approves you because based on your overall profile, you can't afford that mortgage according to the underwriting findings. So it impacts you on the principal and interest, it impacts you on the mortgage insurance. That means it impacts your buying power. Let's say, for example, this same $33, and you understand if the loan amount is higher, you're far different than $33, and maybe the interest rate difference is even as much as 0.5% or greater. So that means on this $33 scenario, if I reverse it, it's $7,800 difference, what you qualify on a 3% versus a 3.25.
Mhm.
So if the loan amount is higher, the monthly payment would be higher, would impact also more or less money, what you can be approved for. The other purchasability impact that it has is to the seller. So we all know right now it's a very competitive market. Sellers are looking for the best buyers because they don't want to take the house off the market and then you don't get approved, they missed out on other buyers, right? So in addition to how much money you're putting down, the type of mortgage you are presenting also makes a big difference. What do I mean? So there's different kinds of loans, like FHA is a government insured loan. And it's a great program, we've used it for years. But in this market, if you have a seller that has two competing offers, one is an FHA pre-approval and one is a conventional pre-approval, they're going to want the conventional, right? Why? Because with an FHA program, there's certain things that have to be met for the appraisal process. The house has to have specific condition property-wise. Like, for example, if there's chipping, peeling paint, FHA says it wants that paint scraped, removed, repainted before you can close on it. So you present as a stronger buyer and you are more likely to get your offer accepted depending on the nature of your pre-approval. Okay. So all around, your mortgage program options impact what your ability is, and from the seller's perspective will impact the amount that you can borrow. All goes back to your credit score, your buying ability, your monthly payment, how you present, everything goes back to your credit score. And as I mentioned earlier with regard to the overall credit profile, somebody who has a stronger credit score might be able to approve at a higher debt to ratio. So just to give you an idea, rule of thumb would be on the back end, what we refer your total mortgage payment plus all your other debt. We look at a 45% debt to income. Well, if you're a strong buyer, maybe the system will approve you up to 50%.
Oh,
Versus if you don't have a strong credit profile, maybe it won't even approve you at 43.
oh no.
So big impact
Big
overall.
impact.
And how much you pay, of course, we all want to pay as little as possible. So that impacts your monthly payment, impacts how high you can get approved, what kind of program all around. Your credit is everything.
Oh yeah, I hear you. Credit is everything. Because sometimes we have people come, like in this very competitive market, that they come with the FHA loan and their offers are denied as not accepted. And they will say, oh, can I just get a conventional? They think it's just simple. Just switch it. Call the loan officer. They switch it from FHA to conventional. It's not that simple. You have to have what it takes, yeah.
And let's assume for a minute that the property is in great condition and your seller is willing to accept FHA. You as a buyer, you want to have options. Why? Because each mortgage is structured a little differently as well. So for example, on an FHA, which there's not just FHA, USDA, VA, they have what are called funding fees, upfront mortgage insurance, additional cost on the loan that a conventional loan doesn't have. Okay?
Right. Mm-hmm.
So if you have, just for simple math, if you have $100,000 loan, FHA is going to add $1,750 to that loan amount to insure that mortgage. You don't have that additional cost on a conventional.
Mm-hmm.
So if you are able to have both choices, you don't want to have to pay more for that same loan amount, right?
Right.
So the structure of the mortgage is also important, not just the interest rate. FHA could, for example, have a lower interest rate today in comparison to a conventional. But when you look at the overall structure, the fact that you have to add this upfront mortgage insurance to a loan amount, and
Mm-hmm.
I said 100,000, so imagine 200, 300 is 2-3 times that amount.
Right.
You're having to pay that much extra money
Right.
to insure the loan. So you don't want to have to go that route if you don't need to. Now, it's a great program. A lot of first-time buyers, I've used it over the years. It is a little bit more lenient, not just on the credit score, but maybe the debt to income. So there's very good reason sometimes to use that program. But if all things consider, everything is equal, you want to have the choice. If you don't have to use it, if there's a better option for you, you want to go the lower cost overall. And there's a difference in structure also on the monthly mortgage insurance. FHA is a different monthly payment on the mortgage insurance in comparison to a conventional loan.
Okay.
So when it drops off also is, different on each mortgage type. So all those things you want to take into consideration, and you want to basically put yourself in the best position possible to not just address your short term, which house will accept my pre-approval, but which mortgage is also best in your best interest long term. So multiple things we need to consider.
So it just goes to show you that credit is everything, because you have higher buying power, lower payment, and you get a better program all around. And like you said, FHA is a great program. It's good for first-time buyers. A lot of people use it. We're not saying if that's the option you have to go, it's okay, go that option, but put yourself in a position where you can get better options because you have great credit.
Yes. And sometimes too, depending on the property, let's say it's a condo.
Okay.
Very different approval process on a conventional than an FHA. If that condo project is not already FHA approved, it's a difficult or more difficult process to get a spot approval on just that unit.
Right.
versus it's a little bit easier if it's a conventional loan. And sometimes when I say conventional, there's great state housing programs. You know, in Massachusetts, we have mass housing. If you're buying Rhode Island and Connecticut, different places have different programs. But they typically use also conventional appraisal. So the appraisal part of it
Mm-hmm.
is critical than the program when it comes to the property conditions. Conventional tends to be a little bit more forgiving as far as the nitty gritty things that they're looking for. So again, in a seller's market right now,
Mm-hmm.
sellers don't necessarily want to do anything to the property. Take
Yep.
it or leave it because there's 10 other people waiting in line.
Yep.
You know,
They just. Mm-hmm. Yeah. Thank you very much. This is an interesting conversation. Now, before I let you go, there is one situation here that we and you, we've done so many loans together. We've gone through this a lot, and most of our agents here sometimes, and this is the situation, we have clients that sometimes complain that the interest rate that they were quoted in the pre-approval stage changes by closing. What are some of the reasons why this happens?
so pre-approval, first of all, is just that. It's not an approval. So at a pre-approval stage, you haven't found a property. So you don't go to full application until you've identified a property. Okay, so there could be big time difference between when you started versus when you actually find the house. So interest rates change every day. Okay, they're dictated by the bond market. So it's live trading every day, just like stocks, just like gasoline goes up and down. When you pull up to the gas pump, what's the gas today? It'll be very different than what it was yesterday. So same applies for interest rates. What you got pre-approved at, the interest rate available at the time, could be very different than what is available at the time that you're ready to lock your rate. And your rate is not guaranteed until you lock your rate, okay? So first of all, you can't lock your interest rate at a pre-approval because you haven't identified your property. You need the property to secure the rate lock. So once your property is accepted and you go to full application, at that point is where you should be discussing, and it should be on your disclosures, what is the interest rate at that moment in time. Once your offer is accepted, the loan officer has to give you a full loan estimate showing you the interest rate and so forth. So at that point, you want to have the discussion, do you want to lock your rate? Do you want to float your rate? And the rate lock is for a certain period of time. So 30 days, 45 days, 60 days. So that's where you're looking at that time, once you've identified this property, your offer has been accepted, are you locking your interest rate or you're floating?
Okay.
You're waiting to lock based on market conditions. So you have to decide, do you want to lock that day of application? And you have to communicate that with your loan officer. Your loan officer should also be monitoring interest rates and making a suggestion to you, like, you know, interest rates are very volatile right now. You might want to lock in because you can't guarantee that this rate is going to be available tomorrow. So that's one function of it. When do you lock? The second function could be that the terms of your pre-approval might have changed. In other words, at pre-approval, let's say you had a 740 credit score. In the interim, you went shopping. Credit card.
You don't have it yet.
So now your credit has to be updated, and perhaps, unfortunately, your credit score went down. Okay. So remember, we talked about before that the interest rate is based on the credit score, the mortgage insurance is based on the credit score. So it could be that during the term of the process from, you know, you started looking for houses 2 months ago versus you're ready lock today,
Yes.
the credit score went down. It could be that you've also changed mortgage programs. You know, maybe you qualified at 3% on a conventional loan, but now that they've done full verification of your income, maybe COVID, you were shut down a little bit, your hours were cut back, maybe you can no longer have the amount of overtime that they thought you could have at the time of the pre-approval. Circumstances might have changed where you can't get approved through this program, you have to switch over to this program. But all of that should be explained to you. It shouldn't be a surprise that you've gone from this rate to this rate. Those are all things that you, first of all, want to ask as a consumer to be sure that you understand. Look, I was told that my interest rate, my monthly payment is this at the time of the approval. What's happening now? Is there an, ask those questions. Things sometimes get busy, and we on this end of the industry may take things sometimes for granted. Well, you as the consumer, you want to ask a lot of questions, make sure you're clear on that. There really shouldn't be a surprise that you started at a 3% rate and now you're at 4%. There should be something in between that's connecting. How did you get here? What was the situation?
Okay.
And speaking of that pre-approval, I would suggest to you that you continually have that conversation of what are interest rates doing. Number one, so you know what your monthly payment is, okay? Number two, that you can kind of rest assured that you'll still get approved. I can tell you we had a situation about 7 weeks ago. Interest rates went up very quickly. Nobody was expecting it because Fed didn't increase it. Then setback was insisting that they're going to keep interest rates low to allow the economy, to improve. But the bond market traders, they started speculating. Inflation coming, this net interest rates went up very quickly, like about 0.5% in a very short period of time. So if you are very tight on, remember the debt to income ratios we talked about, you want to know that at the time that you're putting in an offer, that you're still good with the current interest rate environment, because if it went up 1/4 to 1/2, maybe your pre-approval isn't going to stand anymore.
Right.
So these are constant things you want to bring up in discussion, so you know how to plan what your monthly payment is, and so you also know that you in fact will be able to get fully approved, the loan will close.
Thank you very much.